Hello everybody, this is Cameron Snow with Danomics.com. So we're going to be continuing along with our series on decline curve analysis. And in this episode, what we're going to be focused on is the relationship between our EUR for a well and economics. So when you think about EUR for a well, there's a few different ways we can go about calculating this. We can look at just the lifetime of the well. So we could say something simple like, all right, let's let this well produce for 30 years or 50 years or whatever the number is and calculate, all the production that the forecast says we'll make by that point. We could also put a cutoff on rate. So we could say something like, all right, let's let this well produce until the rate falls below a certain value. So let's say until it falls below 2 barrels per day or some such number. The third way that we can do it, which is the way that I'm going to go about showing you today, is how we can use economics to drive the cutoff for our EUR. I think this is an interesting way to do it, and I also think it's a perhaps a better way to calculate your EURs because that way you avoid some of the problems that you may have with a long tail of production out into the future where your projected rates are quite low. So let's take a look at that. So the first thing you'll want to do is, you would have already came into Danomics, created your project, and forecast out all your wells. So what we're going to do now is we're going to come over here to the economics panel, and we're going to click Enable Economics. And then we're going to want to set this up. So we're going to do a very basic setup here. So let's say use an oil price of around $75 per barrel, 280 for our gas price. Let's say we have a 20% royalty, and let's say our fixed OPEX is around, let's say 4,000 a month, so that's 48,000 a year. Let's say our variable OPEX for oil is $15 a barrel, and for gas it's 22 cents. These are, of course, numbers that you would need to analyze your lease operating expenses to get, but we're making some back of the envelope assumptions here. We also need to know our drilling and completion cost, and then we need to decide what to do with inflation. We're going to set inflation, let's say, at 2% for this well, and we're also going to inflate the OPEX. So yes, our oil and gas prices are going to increase in this scenario, but our OPEX is going to increase along with that. Then we can come in and we can set our oil and gas severance taxes. In this case, in Wyoming, those are both 6%. And then if you'd like to look at your, after-tax cash flows, let's say, we can put in your corporate tax rate. We can also take a discounted rate, put in some abandonment cost. Now, we still want to limit the well life in this scenario. You could see scenarios where even with these constraints, well may have a very long producing life depending on the forecast. We're going to, let's say, cap that at 40 years in this case. And then, we've just got a few display options on how we want to display this, whether or not it's by year or by month. Now, once we've set that up and we've enabled economics, you'll notice that over here in the stats window, we now have our revenues that are associated with that well. But probably what's more relevant is we now have an economics cutoff that's been flagged here. So we can see this is the point where, based on this set of economic criteria, where our well will go offline, and that's where our EUR is going to be truncated, is at this point right here. And for things like our fluid summary graph, this is where this well will come offline. So that's one of the areas where we can see the impact of adding economics. The other, of course, is to our economics display. So a couple of neat things in here that I want to highlight. So first of all, we have our reported production here, shown by the term report for mixed years. So this is the year that the well changed over from reported to forecast data. We flag that, and then we flag all the projected economics out here into the future. We'll display the monthly oil and gas volumes, your oil and gas prices, and of course, we just multiply those two together to get our revenues for both. That comes down to a total revenue line. And then we can start taking out royalties, severance taxes, our fixed and variable OPEXs to get down to an operating income. We can integrate that with our drilling and completion cost to get a before tax cash flow. And this is, this is the key number that you're going to want to look at here. It's quite important, and we can see, here in the case of this well, about 18 years into its productive life, that's where it switches from, positive to negative on our before tax cash flow. So that's when this well would be shut in and brought offline. We also have a discounted cash flow here. So obviously it's important to take into account the time value of money. So we've got our discounted before tax cash flows here. And we have our internal rate of returns, so the IRRs on both a before and after tax basis. We have our before and after tax NPVs. And we also have our forward-looking NPV, so how much of the NPV is remaining. And this is an interesting one to look at, because if you were to, let's say, want to go out and buy this well, this is the remaining NPV, including the abandonment liability that we put in here for the abandonment cost. So that is just a quick summary of how our economics and EURs work together to give us a interesting view of how we can use the economics to drive our EUR calculations. All right, I hope that was interesting to you. If you'd like to learn more, reach out to us at sales@danomics.com. Thank you.